Hi everyone, welcome to Fifth Dimension, and today we will be evaluating a very hot stock, Microsoft. And for this evaluation, we will be using the principles from the book of Benjamin Graham, The Intelligent Investor, and also from the book of Phil Town, Rule Number One. And first, before evaluating or coming up with a price, we will first see if this company has a moat or not. By moat, I mean if this company has a competitive advantage or not. And Warren Buffett really focused on this point that you need to find if the company has a competitive advantage or it has a moat or not. And for that, Phil Town suggested that we have to look for 5 big numbers. So it's ROI, return on invested capital, ROIC, revenue growth, equity growth, earning per share growth, and finally free cash flow growth. And once you check the growth rates and the ROIC, and if all of them are 10% on average for the last 7 to 10 years, then we can say this company is a wonderful company and it has a moat. And then we evaluate, and when we evaluate, we see if this price is below the current price or not. So we will start first, we'll check first number, return on invested capital, ROIC, and for that we will go, by the way, I'll be putting all the links in the description of this video. So we will go to financecharts.com and there we will search Microsoft. And here we could see that ROIC for 10 years is 25%, which is well above 10% threshold. Now we will go towards revenue growth or sales growth. We'll see if this company is growing on average 10% annually. And for that, we will go to msn.com and analysis. And then from analysis, we will go to income statement. And we could see that its revenue is growing from 91.15 billion to 211.92 billion in 7 years from 2016 to 2023. And we'll check if this growth, if it's growing on an average of 10% annually. So for that, we'll go to rule1investing.com. There we'll go towards investment education, and then we will choose investment calculators, and then we will go scroll down and we'll see the sales growth or the revenue growth. And we could see that the initial sales in 2016, it was roughly 91 billions, and it went up to 211 billion. So we could see in 7 years, so we have to select 7 years. So in 7 years, it grows 13% on average per year. So this is also checked. Our 2 big numbers are checked, ROIC and revenue, and now we'll see earning per share growth rate. And for that, we'll go to same page, income statement, and there we will scroll down. Now we could see this EPS, and it went from 2.56 to 9.68 in 7 years from 2016 to 2023. And we'll go again to Rule 1 website, investment calculators, scroll down, earning per share growth. And we remember that initial EPS was 2.56 and it went up to 9.68 in 7 years. So 21%, which is well above 10%. Now we will check our 4th important number, which is equity growth. And for that, we will go to balance sheet here. And we could see that its equity went from 72 billion to 206 billion. And then in order to calculate the growth rate, we will again go to investment, rule number 1, investment calculators. Then we will go to equity growth. And We remember that the initial equity was in 2016 72 billion, and it went up to 206 roughly in 7 years. So it's 16%. So equity growth rate is 16%, which is also above 10% annually on average. And now we will go to our final number, which is free cash flow. And we could see that it went from 24.98 to 59.48 billion in 7 years. And for its growth calculation, we will again go to investment calculators, go to free cash flow. And now we will see oldest cash flow. So 7 years ago, it was 24.98, and it went up to 59.48 in 7 years. So it's 13%, so it's also above 10%. So we could see that all our big five numbers are well above 10%. And now we will calculate, we could see that it has a mode. Now we will calculate the margin of safety price and see if it's worth buying or not. So if it's undervalued, we could buy, and if it's overvalued, we'll wait until it's below that value. By the way, just a disclaimer again that I'm not your financial advisor. It's just an educational video. You can learn from it and do your own research before buying any share. So in order to calculate, coming back to the topic, in order to calculate margin of safety price, we'll go to investment calculator. There we will go to sticker price. So it will give us actual value or the estimated value of the company. And then we'll compare against the price. So for that, we need EPS. And for that, we will go to msn.com, summary. And here we could see EPS trailing 12 month is 11.54. So it's 11.54, and then growth rate. For future growth rate, we will see two numbers and choose the lesser one. So we'll see what analysts are saying on Zacks.com. It's 16%, and we will compare it against equity and see which number is lower. And equity was coincidentally also 16%, so we will choose 16. So the idea is to choose between what analysts are saying about its growth and equity, and whatever is less, we will choose that. So it's 16. And for future PE, we will see three numbers. First, what analysts are saying, which is 32 forward PE. The second is the twice of equity, which is also 32 coincidentally. And the third is we'll see past PE. And for that, for past PE, average PE for last 7 to 10 years. And for that, we will go to, again, msn.com, analysis, annual. And what we will do is we will, here under valuation, we'll look this thing, price to earning, and we will calculate the average of it. So we will add all of them and divide it by the number of years, and then we'll get the average price to earning ratio for last 7 to 8 years. And I have already calculated it, and it is around 27.87. 27.87, and it is $175. So we could clearly see that the price through, so this is the sticker price, which is like the estimated price, but the book suggests to be conservative and divided it by 2. And all the investors like Warren Buffett suggest to have margin of safety. So they suggest to have a margins of safety around 30 to 50%. So we have margin of safety here 50%. So we have 175, and we are expecting the minimum rate of it return 15. So if we want lesser return, then the price will change. So then the price is 274. So if someone is expecting a rate of return, let's say 10%, then he could buy at around 274. But we are expecting, and in the book they suggest to have at least 15%. So according to that, it is 175. And we could clearly see that the price is well below 175. So the price is here, the current price is 425. So it's well above our evaluation. So you can see this evaluation is very conservative. So it leaves very less room for an error or for a loss. So it's very risk averse evaluation of a stock price. So that is all from my side. So personally, I would suggest you guys to do your own research as well. But personally, I wouldn't buy this share right now unless it gets undervalued or it gets below the margin of safety price. So that is all from my side today on Fifth Dimension, and I will see you in the next video with a even hotter stock. And please suggest me if you guys are interested that I make a video for another stock. So please let me know. And thanks a lot and see you guys next time.